investors' attention was primarily focused on the Federal Open Market Committee meeting last month. So in line with the expectations, the Fed members kept their federal funds rate target range unchanged at 5 and 5.25%. However, it is certainly worth noting that the conference and the press release both focus on time that is needed to assess the incoming data to make further decisions on interest rate movements. However, there were several updates worth noting in their projections statement. So we saw growth being lifted to about 1% this year from 0.4% previously, in line with much better than expected data that was being primarily fueled by credit spending. And we also saw inflation prospects, particularly on the core side, lifted to about 3.9% this year from 3.6% previously. And that really shows that broad-based nature of inflation is particularly evident in the mind of the Federal Reserve members, given the fact that they have also now lifted their interest rate expectations for where the federal funds rate is going to go over the next 3 years in terms of their projection outlook. We are particularly concerned about the credit-fueled spending heading into the second half of the year, particularly because of the fact that student debt payments that amass to over $1.6 trillion are now starting to be reactivated as we head into October. This is if Biden does not succeed in invoking another law to waive these outstanding loans. Also, what we are concerned about going into the second half of the year is the potential drain in the liquidity impulse that may have an effect on overvalued stocks. In emerging markets, it is particularly encouraging that the People's Bank of China slashed several interest rates over the month in terms of further accommodating the monetary policy to stimulate the economy. However, we do acknowledge that we have seen some weakness in the coincident and lagging economic data in China, and this excess savings that we all know too well of is certainly not finding its way through to the real economy. And in fact, we have started to see that there has been prepayment of mortgages amongst Chinese citizens. So to us, this reflects a broader confidence issue in the Chinese economy. So going forward, we think that with further liquidity injections, it still presents material opportunity, but more selective opportunity. This, combined with very low inflation and low valuation prospects, also warrants further capital allocation to selected opportunities. In one of the most unprecedented monetary policy moves in history, we see that the Bank of Japan is continuing to inject liquidity into the system, and resultantly, we have seen the Nikkei jump about 8% in the month of June and up close to 30% year to date. If we look over to other parts of the Western world and look at the Bank of England, for example, they surprised market participants by raising the bank rate by 50 basis points to 5%. And if we look over in the Eurozone, they also continue to hike rates by lifting their refinancing rate by 25 basis points toward 4% now. And this has amid broad-based inflationary pressures, particularly in the UK, where core inflation is at untenably high levels, nearly at levels where we haven't seen for the past half a century. Going forward, we are concerned about the ample liquidity injections that we have seen year to date. So we are going to closely monitor a perverse effect of a potential drain in liquidity going forward, because we believe that that is necessary in order to bring core inflation levels, particularly in the Western world, to more sustainable levels. And this comes on the back of needing to refill the US Treasury cash account after the debt ceiling was lifted, given the fact that that is likely to be net liquidity negative, depending on where the source of funds is coming from. So we think that selected opportunities will certainly emerge once this takes place. However, from a beta-adjusted perspective, we are continuously cognizant of the amount of risk that needs to be taken.